Okay, hello everyone. Let's go ahead and get started. We have another great Mayo Center for Asset Management virtual research seminar for you today. We have a really good session. But before we begin, I'd like to once again first say thank you to the many who have been working so hard to keep everyone safe and well in this challenging time. Our sincere thanks go out to all of you. By way of introduction, I'm Rodney Sullivan. I'm the Executive Director of the Richard A. Mayo Center for Asset Management here at the University of Virginia Darden School of Business. And it is my pleasure to welcome you all here for today's call. For those of you new to this series, the Mayo Center is a center of excellence here at Darden with a mission to focus on applied academic research and education. And consistent with that mission, the purpose of this virtual seminar series is, of course, to advance the study and practice of asset management through research and education. I'd also like to take a moment to thank our co-sponsor for this series, the Financial Management Association International. We are deeply grateful for your partnership, so thank you. Before we begin, let me share a few housekeeping items with you. All participant microphones have been muted, videos are turned off, and also for those of you who have questions for today's speaker, we ask that you please send them into the Q&A box that's located at the bottom of your screen. And what we'll do is we'll collect them throughout today's session, and we'll put as many of them as we can, as time allows, to our speaker following his prepared remarks. Note that we will be posting a video of today's session on our website, so be on the lookout for that in the coming days. Okay, with that background, let's go ahead and move on to today's program. It's my pleasure to introduce our moderator for today's session, Professor Pedro Matos. Pedro is the John McFarland Family Chair Professor here at Darden, and he is also the Academic Director of the Mayo Center for Asset Management. So Pedro, thank you. Over to you.
Thanks, Rodney. Hello, everyone. So happy to kick this off and see so many familiar names joining us via Zoom. So allow me to introduce the speaker for today's seminar, Alex Edmans, Professor of Finance at LBS, Academic Director of the Center for Corporate Governance over there, editor at major academic journals. I'm sure many of you know him. Also won numerous research prizes, including in the space that we're talking about on social responsible investing, the Moscovitz Prize, etc. His research has been covered in the press, the major outlets, spoken at numerous forums like the World Economic Forum, testified to the UK Parliament on many of the issues. He has this very high-watched TED Talks, which I recommend on truth in the post-truth world and take social responsibility of business. He's serving on a few advisory committees, and more importantly, his book has come out, Grow the Pie, How Great Companies Deliver Both Purpose and Profit, which was published earlier in the spring and headed the list of the Financial Times business books of the month. So we're fortunate to have him as today's speaker on responsible investing, what it does it work, and how to do it. So Alex, over to you. Thanks for joining us.
Great. Well, thanks so much, Pedro. Thanks to the Mayo Center and to the FMA for having me. And thank you to everybody for participating. I know there's a lot going on in the world right now. So thank you for those of you giving up the hour to hear my thoughts on this topic. So as Pedro says, I'm going to talk about responsible investing. But before looking at does it work and how to do it, let's look at what is it? And you might think that's a strange place to start because isn't it obvious what a responsible investor should be doing? But in fact, I might have a quite different view on what responsible investing entails than what we might typically think. So let's start with a story, an example to set the scene. So what is responsible investing? Well, let me give an example of something that many people thought was a perfect example of irresponsibility. So this happened last year. So Disney CEO Bob Iger, he made 1,424 times as much as his employees. That sounds crazy, right? We believe that CEOs should get paid more than workers, but 1,424 times, that just seems obscene. An heir to the Disney fortune, Abigail Disney, said that this was insane, and any responsible investor should not want to invest in such a company. Right, for a couple of reasons. Number one, if it leads to inequality, then employees might become less productive because the environment is just one with a star culture. And number two, beyond shareholder value, we care about inequality within society. However, as academics, we want to look at this and say, well, maybe there's a couple of sides to the story. So it's indeed true that Bob was paid $66 million, but in the past month, Disney's market value had risen by $75 billion. Now, obviously, as responsible investors, we care about the long term, so that in itself doesn't mean much. But if we looked at how well Disney had done since he'd taken over, the stock price had gone up nearly 600% compared to 140% for the S&P 500. And also, as responsible investors, we don't just care about shareholder returns, but 70,000 jobs had been created. And also, this value creation wasn't at the expense of customers. It was a byproduct of actually creating a lot of value for customers. Now, clearly, all of this wasn't just due to Bob Iger. There were lots of other people within the company. Maybe he was only responsible for 1% of this value creation, and that's a reasonable place to start. But before we establish whether pay was responsible or not, we have to look at, is this linked to long-term performance? And in fact, to have high pay is not necessarily irresponsible. And so this is something where, as you'll probably know, the AFL-CIO, they look at the pay ratio data every year. They say, well, there's more for them, it's less for us. But that implicitly assumes that there is a fixed pie, right? So the pie is the value that a company creates, and any slice of the pie, which goes to executives, is at the expense of wider society. So what a responsible investor should do is to split the pie differently. Like crack down on CEO pay so there's more to go to other people. And so that's true not just for CEO pay, but it's also true potentially for profits. So Time Magazine has this website where if you are to land on it, it says how much money companies are making in every minute. And again, the idea is that if they're making money, it's at the expense of everybody else. And therefore, what a responsible investor should do is to make sure that companies pay higher wages than they need to, pay a higher taxes than they can get away with. Again, responsibility is about a fair split of the pie. So I would disagree with that. So this is why my view of responsibility is different to what some investors and some politicians believe. It's not just about the division of a fixed pie, but it's also about the size of the pie. And just to highlight this in terms of a very stark example, in 1981, Sony launched the Mavica, which was the first ever electronic camera. Now, if you were Kodak, how would you respond? So Kodak themselves actually had a patent for the digital camera. They'd launched this patent, they'd filed it 5 years ago. Now, the digital camera they had doesn't look like what we have right now. It was a little bit inelegant, but it was something that they could have chosen to develop if they wanted to in order to rival Sony. But they just couldn't be bothered, right? Because film, their main business, had crossed $10 billion of sales. And so why respond to this threat? So we know how this movie ended, right? So what happened was that Kodak ended up going bankrupt in 2012. This was a disaster for society. It was worth $31 billion of shareholder value in 1997. And it was bad also for employees. So at its peak, it had employed nearly 150,000 employees. But why I have this example is this is rarely thought of as an example of irresponsibility, right? So this was not a case in which CEOs lined their profits at the expense of wider society. It was not a case in which shareholders took huge dividends and received huge buybacks at the expense of worker wages. But I think this is perhaps the greatest example of irresponsibility that we have, just due to complacency and failure to innovate. A once great company failed. So when we think about responsibility, I think the first order question is not, is the CEO or are shareholders benefiting at the expense of everybody else, but is the company failing to create value to begin with? Because one of the most irresponsible actions is not to pay yourself too much, but to coast and to hog the status quo. Which goes back to the pie idea, like the main thing that a responsible investor should try to encourage is to grow the pie through excellence, through innovation, through not being willing to stick with the status quo rather than being a fair division. Now, if you start with that premise, you might think, okay, this is a different view to what I typically heard, but you might be skeptical because you might think, well, does this have anything different to do with Milton Friedman? Because, well, Milton Friedman said, the social responsibility of business is to increase profits. That would mean that we would want to innovate and we'd want to pursue excellence. And indeed, as long as we define Friedman's profits as being long-term profits, that would seem to be consistent with everything that I've said. Now, Friedman's article on its 50th anniversary is perhaps one of the most unpopular examples today, right? It's almost a requirement to be accepted in polite society to say how much you disagree with the Friedman doctrine. But in fact, a careful reading of this shows that actually Friedman did not say we're going to exploit investors in order to pursue profits. He said that the only reason, the reason why it's fine for a company to focus on profits is that in order to maximize profits, at least in the long term, we have to care about society and to grow the pie. So therefore, how is my view of responsible business different from Friedman? It's on the motivation. So what Friedman argues is that we make decisions in an instrumental way. So this is what the finance professors on this audience, we've taught our students, right? We will calculate if we're to build a new factory, how many widgets that factory will produce, how much we can sell them for, and if it's positive, if it exceeds the cost, we're going to take it. Now that works for tangible assets like a factory, but what about something intangible? So let's say we're going to give our employees more parental leave. Now, can we calculate how much more money that they are going to be making and whether this is going to be leading to greater profits in the long term? Well, actually, no, it's really difficult to calculate the benefits of parental leave. And indeed, this is why some companies, when you're making purely an instrumental calculation, you're going to fail to do this. And so this is why the responsible business approach is going to be quite different. Right? We are going to invest in parental leave just because we think it's the right thing to do, even without a calculation. And if we do that, then ultimately we might become more profitable as a byproduct, even if we could not see the profit benefits. And so some research by Leah Stern and others has suggested that that's indeed what the case is. And so this is something I consider in more detail in a recent article for Luigi Zingala's website, is actually Milton Friedman is much more nuanced than what we might think, yet responsible business goes beyond just long-term shareholder value maximization. Why? Because it's something where the motivation is intrinsic rather than instrumental. And in a world of uncertainty, particularly Knightian uncertainty, it's very difficult to make a decision based on a net present value analysis based on what we can predict. So maybe there is something to support the idea of investing in our stakeholders for intrinsic reasons, and ultimately that might lead to more profits down the line. So what we want to look at is, does this approach work? And this is what, as academics, we spend a lot of our lives doing. So what I want to do is look at the evidence for ESG investing. Is this something that pays off, and should responsible investors care about it? Now, the important thing about evidence is that we need to be very careful about confirmation bias. And so this was the topic in the TED talk that Pedro kindly mentioned. Right, we would like to accept evidence if it confirms what we would like to be true. So let's say I'm a climate change denier. I'm not, but hypothetically, if I was, right, if I found a report saying climate change was a hoax, I'm going to latch onto this without scrutinizing it. And this is a particular issue with responsible investing, right? Because everybody likes to believe that ethical companies always perform better. So if there's a study coming out showing that actually ESG has paid off during the pandemic, then everybody might want to latch onto that very immediately. even though, as work by Elizabeth Demis and others have shown, well, actually, maybe this is a technology versus energy premium. So we want to be much more careful about this if we want to look at the evidence on responsible business. And just to give you one example here, let's take Forbes, right? This is supposedly a very reliable source. And what they said is that companies that excel in their sustainability and responsibility outperform their peers financially. So there's nothing wrong with that statement. They're just reporting a study. But here's the problem. That is the premise of a new report, and it is an accurate one, judging by many conversations with those interested in better business, better governance, and a sustainable future. So how is it that the journalists judged whether this report is accurate, not by looking at the methodological rigor, but just by asking people who believe in governance and sustainability, do you think that this is accurate? And obviously they would say yes. So this is the issue of confirmation bias here. So we want to be much more careful about this as academics and also as investors who want to use this to shape our strategies. And so what I want to do is to look at some of the most influential papers on this topic, and most of them admittedly are on the G of ESG. So this is a paper that most people will be familiar with. So what it takes is various things that companies can put into place in order to protect themselves from shareholder oversight. So the staggered board, the golden parachute, and the poison pill being an example. Now you might think if you're doing this, that is really bad governance, right? You're insulating yourself from shareholders. But in fact, there is a flip side, right? What is the biggest problem, the biggest concern that many people claim about capitalism today? They say it's short-termist. They say you've got these pesky investors who are just too focused on quarterly earnings. So if we could only insulate companies from these short-term pesky investors, then companies would perform better on the long term. And indeed, you'll see things such as the long-term stock exchange in California, which are trying to reduce shareholder oversight to focus on the long term. So which is it? Is it that these entrenchment devices end up allowing a company to pursue the long term? Or does it entrench bad management? Well, what the study by Composition Metrics suggests is that well-governed companies without these governance provisions beat poorly governed companies by 8.5% per year over a 9-year period. Okay, so that's something that everybody will know as an academic, and this is something which sparked the ESG movement partially among investors. Governance is always a good thing. Let's always try to get some high shareholder rights. But actually, this paper is not the last word, right? Because there were some papers which came along and said, well, actually, that's not always going to be the case, right? So there's a paper by Xavier Giroux and Holger Müller, which says, yeah, we do want good governance, but governance is not the only way to make sure a CEO maximizes the value of her firm, right? So if indeed the industry is really competitive, then she will maximize value, even if there's a poison pill and a golden parachute, because if not, she's going to be kicked out by industry competition. So what they said was, well, actually, only if you're in a non-competitive industry might you actually want to have high governance and good shareholder rights. And indeed, when they redid the study, they found that this was only true in the non-competitive industries. And that itself is quite striking, right? Because often investors will evaluate governance on a box-ticking way, right? So if you don't tick the governance box of not having these defenses, then you are out. But actually, the evidence is much more nuanced. Yes, we would like the evidence of governance to be very universal so that we can tweet it in 280 characters. And anybody who says governance always pays off, that is going to be something which is widely shared. It's a much more palatable message than governance sometimes works and sometimes it doesn't matter. But as careful investors, it's actually the more nuanced message, which is often what's backed up by the data. And not only can governance sometimes not be important, sometimes it can backfire. So a paper in the Journal of Financial Economics by Johnson, Karpov, and Yee. So what they say is that, well, sometimes a company might have a long-term stakeholder relationship. So they give this example of Capemstar, a contract manufacturer, which went public in 2000. And at the time, IBM was the largest customer. And so the concern here is that, well, if they were to go public, these investors might pressure Pemstar to milk this IBM relationship. And so what they did was they put in some takeover defenses to make sure that they didn't fall victim to the short-termist pressures. And indeed, what this paper found was that the valuation that the company commanded upon IPO was actually higher if you had more takeover defenses, but if and only if you had a large customer or a strategic alliance or a dependent supplier. So what this means, going back to the debate, is it's neither the case that we always want good governance or the case that shareholders are always short-termists. In fact, it's going to be that sometimes we do want shareholder rights and other times we don't, but that's something which is not always taken into account in some of the frameworks used to implement responsible investing. Okay, I don't have time for this, so let me just skip to executive pay, which is something which has got a lot of attention recently. So there's a lot of focus on pay, and this focus on pay is based on the pay ratio often. So as we know, in the US and the UK now, companies need to disclose pay ratios, and there's work by Audra Boone and Josh White and so forth on looking at what's happening with this pay ratio disclosure. Now, this is in part based on some evidence which argues that high pay ratios are bad for firm value because they suggest that the firm is unfair. So a few years ago, I was testifying in the House of Commons in this inquiry into corporate governance. The witness before me was the Trade Union Congress. So this was the equivalent of the AFL-CIO in the US. And they referred to a study which found that firm productivity is negatively correlated with the pay ratio. The idea is that if you have a high pay ratio, then the firm is going to be less productive because employees think that the firm is unfair. So what they did was they quoted a half-finished study. So they quoted a working paper. And in fact, that working paper had been published. And after going through peer review and tightening its methodology, it actually found completely the opposite result. So what they found was that performance is actually higher. The higher the pay ratio is, firm value and operating performance go up with relative pay. And so this shows just how careful we need to be with academic research, because it's possible to find even a half-finished working paper which supports what you would like to be true, even if there's a finished version which finds the opposite. And again, why might this not be the case? Right, the idea of pay ratios being bad assumes a fixed pie, when in fact, actually, the pay ratio could be high because the CEO has created a lot of value. So if we go back to pay, what matters isn't so much the quantum of pay or the level, but the structure of pay. Is there something which is going to lead to long-term value creation? And that's something which is looked at by a study in the 2014 Journal of Finance. So what these pay people look at is they say, well, if what matters is not the level of pay, but the structure, what we would like is a CEO with a lot of skin in the game, because when they hold the stake, they will be motivated to create value. And so they take a pretty simple strategy of buying companies where the CEO owns a lot of shares in her firm, and then they short companies where the CEO owns few shares in her firm. And what they find is that this outperforms, this gets an alpha of 4 to 10 percentage points per year. But as we know, correlation does not imply causation. So the question is, well, is it that when the CEO has a lot of shares, she works really hard and generates a lot of value? Or is it the opposite? Maybe the CEO already knows how well her company will be performing. And if she knows that the company's going to do well, she goes to the board and says, give me stock. But if she knows that the company's going to do badly, she says, give me cash. So what the authors do is they do some cross-sectional tests to suggest that it is the first. Why? Because if indeed it is incentives that cause better performance, that is going to be even more the case when there's little institutional ownership, because then the CEO is likely to slack off. When there's weak external governance, when there's weak product market competition, and all of this suggests that actually incentives do matter, and indeed the relationship is stronger. So again, well, why am I contrasting the pay ratio study to the incentive study? This goes back to the idea of what responsible investing is. It's not so much about the division of a pie, right? Because that assumes a fixed pie, but it's about the incentives to grow the pie and create value. And that's why it's the structure of pay that particularly matters. Now, what matters is if you're given some equity pay, is the horizon of pay, because if you're given shares and the shares can vest immediately, then that can cause some short-termist actions. So instead, what we want to do is to look at some shares which have long vesting periods. A lot of papers here, let me not cite my own actually, because we're close to out of time. Let me cite the second one, because it's also a paper in the strategy literature, which not all finance people may be aware of. So what they're looking at is what happens when a company has a shareholder proposal to implement long-term pay. Now, if we looked at that and we saw what happens after the shareholder proposal, that would not be causality, because shareholder proposals don't arise randomly. It could be that there's a large engaged investor, like the Norwegian Sovereign Wealth Fund, which comes in and puts in this proposal. So what they did is they did a regression discontinuity analysis. So apologies to all the academics who know what this entails, but just to summarize, what is that? They look at companies which put in this proposal to implement long-term pay, and there's some proposals that failed with only 49% of the vote. There are others that succeeded and got 51% of the vote. Now, the idea here is that whether you fail with 49 or whether you succeed with 51, that is essentially random. That is not going to be caused by the Norwegian Sovereign Wealth Fund, because if the Norwegian Sovereign Wealth Fund was there, they would take the voting support up to 70%, not to 51. So these small random variations as to whether you succeed or fail, that enable them to have a causal effect of the long-term pay scheme on future performance. So what do you think happened to profitability? It dropped. But it only dropped in the short term. It rebounded in the long term, which makes sense, because when the CEO has a long-term horizon, she is going to invest in her workers and invest in reducing carbon footprint. And maybe in the long term, that's going to bounce back. Also, what happened to innovation? Well, the company was producing more patents, higher quality patents and more novel patents. And then various measures of responsibility went up, in particular, how well they were treating their workers. Again, this suggests a responsible company is not one that thinks, let me cut the CEO's pay and then give this more to the workers, because there's not actually that much to be redistributed. Instead, let me pay the CEO according to the long term, and if so, she will have the incentives to innovate more and to invest in the employees and the other stakeholders. Okay, so everything I've looked at so far has been on governance. I want to make sure I have enough time for the E and the S. So what I'm going to now present is one of my own papers on the S, on employee satisfaction. And this is why I got interested into this responsible investing topic when I was a PhD student at MIT. So what I wanted to look at is, well, let's have a measure of how well a company treats its stakeholders, and then look at, is this correlated with long-term performance, or are companies that care about their stakeholders just not being successful companies, they're being fluffy, right? As a theorist, right, we know that if you want to maximize shareholder value, you hold workers to their individual rationality constraint, right? If you give them more than their outside option, you're not maximizing shareholder value. But is there anything to support sort of this efficiency wage idea that if you give workers more than they need to, they might be more productive? And what I looked at was the list of the 100 best companies to work for in America. And I found that over a 28-year period, these companies outperform their peers by 2.3 to 3.8% per year. And so that's 89 to 184% compounded. And so what was really interesting about that data set is that it was available from 1984. So I had tons of data. Responsible investing is a pretty new movement. And so many of the data sets have only been around, let's say, since 2010. And so if I showed that responsibility paid off from 2010 to 2019, you might think, well, it only works in an upswing. Right now in a pandemic, maybe we shouldn't think about it. But because this was such an old data set, it contained September the 11th, it contained the financial crisis. So this is something that I could see was robust across different time periods. Now, again, one of the biggest issues is causality, and I cannot claim to have the regression discontinuity of the earlier paper. But here's something that might hopefully address some potential issues. So the concern here is there an omitted variable? Maybe there's a great management team, which is both causing employees to be happy and also causing firm performance to be better. So what I try to look at is the future earnings surprises of the company. Every 3 months in the US, companies announce their earnings. Before they do that, the Goldman Sachs's and Morgan Stanley's of the world predict what the earnings will be. And so if indeed the company is systematically beating those earnings announcements, it must be due to something over and above what the equity analysts are taking into account when they're indeed making the earnings forecasts. And indeed, given equity analysts all the time look at things such as current performance and management quality, that's something which at least moves me towards thinking that employee satisfaction is the driver of this, even though I cannot claim causality as strongly as a paper which had an instrument or a natural experiment. Okay, there's other papers which look at this in terms of other dimensions of the S, but let me just go quickly to my final section before turning it back to the Q&A, is how to do it. So this is something I've seen hugely change over my 15 years working on this, is that when I first went to my first SRI conference in 2007, what the main method there was screening or exclusion, right? So we practice responsibility by kicking out certain stocks that don't tick a particular box. So they could be in a sin industry, they could have a low board diversity, they could have a high pay ratio, maybe they don't treat their work as well. But hopefully over the course of the last half an hour or so, I've highlighted the limitations of such a screening method. Right, some of these things are not one size fits all. So what we see to be poor governance might not actually matter if we're in a competitive industry or if we've got a strategic alliance. Or maybe it's not backed up by the academic research, something like a pay ratio, which we think to be poor governance, actually could be correlated positively with long-term shareholder value and not the opposite. And even something like employee satisfaction, right, which you think I should really care about given my study, this is only one issue that a company has. Right, there's lots of different stakeholders out there, and it might be that your record in employees is not great, but this is offset by the lot of good that you're doing in many of the other areas. Let's say innovation, which is what I started the talk with, that is one of the biggest ways in which a company serves society, but it's something which is not typically taken into account by these responsibility measures. So the main thing that I'm seeing in terms of the biggest innovations now is in terms of integration. So what we're doing here, it's not lexicographic. It's not you look at the ESG, and as long as you're not too bad, you've got your foot in the door. And then once your foot in the door, then you're going to evaluate everything on financial criteria. Instead, what we're going to do is we're going to consider the ESG factors alongside the financial factors when making these decisions. So what we do at Royal London, so I serve on the Responsible Investment Committee, is it's called a net benefit test. So we ask the question, does the company provide a net benefit to society? Right, so this is something where it's a holistic approach. We look at the bad things that a company might be doing in terms of maybe low diversity or a high pay ratio, but we use this and we counterbalance this against the goods. And so are they innovating? Are they producing products that address big social problems? Now, the huge problem with this is that it's subjective. And I know there's a lot of investors who think, well, can we whittle this down to a single ESG rating so that we can use this as an objective way? Now, fortunately, we can't. And why is that fortunate? Because if there was a single ESG rating, which would be perfect, then everybody would be out of a job, right? There'd be no need to have human investors, right? We could just have a smart beta fund trading on behalf of these ESG ratings, and then there wouldn't be need for human judgment. So these issues are difficult to judge. They are subjective, and this makes people think, well, we don't want to engage in ESG. It's something which is nebulous. But actually, The fact that it is so difficult, we need to take strategic context into account, materiality into account, means that I think it's something that all human investors should want to focus on. And in fact, my sort of cry for the profession is that if we want to investigate and to educate our students to be investors in the future, in addition to the balance sheets and the cash flow statements and the profit and loss accounts, which we typically teach in Brealey, Myers and Allen, those are things which maybe computers will be able to focus on in 10 years' time. Maybe they're already doing this. So it's instead these intangible factors, which are really important drivers of a company's value, which we need to actually educate our students in doing. And as asset management firms, we want to develop expertise in, because those are the things which are most likely to be mispriced by the market. Lots of more things to say, but let me not go through this because I'd rather hear from you. So let me hand back to Pedro to do the Q&A. Thank you so much again for the opportunity.
Thanks for a great presentation, Alex. Great, strong attendance, and reminder to everyone to submit any questions on the Q&A box at the bottom of your screen. So again, congrats on the launch of your book. So let's dig right in. It's a crazy world, and with COVID, US elections here, it was, highlight all your work on purpose, and also that the investors are not the enemy, and sort of this focus on the responsibility of investors. But I think what distinguishes your work is, as an academic, that we are providing this evidence-based research, that we don't treat evidence as truth. So I point everyone to Alex pinned tweet at his Twitter, which is really, about finding truth, and even evidence may not be truth. So just, let's keep an open mind as, we all explore all these issues. So we have a lot to cover. The book is long, and there would be, you could spend hours on each. But I'm going to try to dig in on this pie economics and your favoring of pie growing over pie splitting that permeates all your work. And the first question we had in the Q&A was actually the same question I had if I were to go teach my next class. So how do we help me explain my students? How do we compute all these trade-offs without using the NPV rule, or sort of and another question in the audience is, are all these things mispriced, and how can you really take a measure of the environmental or social other dimensions of a decision, so that you can make sure that you're taking those into account, and that in some ways that this future profits and these externalities are aligned. So how do you handle the cases when they're very difficult to estimate, and how do you handle the cases that even in the long run, these things may never materialize into future profits?
Thanks, Pedro. I think this is a really important question, right? Because if indeed we are going to depart from just purely shareholder value, or NPV, we need another decision rule. And that's something that a lot of advocates of responsible business or critics of shareholder capitalism never have an answer to. Right, because we need a way of deciding what investments to take and what to turn down. It certainly can't be the case that a company takes all of the investments. So in chapter 3, I go through 3 principles that a CEO should think about, but let me just go through one in the interest of time. And this is the idea of materiality. So what do I mean by materiality? Well, there's a lot of stakeholders out there. There's customers, there's the environment, there's workers, and so on. Now, if you want to say the business roundtable, you would say, let's serve all the stakeholders. But that's not possible, right? There are decisions that we will make which will trade them off, even if we don't consider shareholders. Let's say we're going to shut down a polluting plant. That's good for the environment, but it's bad for your workers. So if our goal is to satisfy workers and the environment, it doesn't help us make that trade-off. So the idea of materiality means that for every company, there will be particular issues that are more important than others. So let me go back to screen sharing. So this is the Sustainability Accounting Standards Board materiality map. So what this does is it goes industry by industry, and it says, well, what are the most material stakeholders in your industry? So let's say we're the first column, minerals, processing, mining. The environment is massive. You have a huge impact. But what about financials, banks and insurance? Right, at least your direct effect on the environment is not large. Instead, what is more important is to make sure we're not, say, in a Wells Fargo fake bank account scandal to make sure our social capital is high. And some of you will know this study by Khan, Seraphim, and Yun in the accounting review, which shows that if you're a company and you do well on all of these stakeholder dimensions, you don't actually beat the market. You only beat it by 1.5% per year. But if you do well on only the material issues and you scale back on the immaterial ones, you do beat the market. So what it says is that one of the important lenses to know how to make these decisions is, are the stakeholders that I'm benefiting the most material stakeholders for the business? And notice that this answer is pretty uncomfortable, right? Because everybody likes to think climate change is the order of the day. Let's do all that we can to reduce our carbon footprint. But it says actually, if you're a bank, well, maybe the most important thing that you can do is to make sure you focus on data privacy and customer security, even if climate change is the bandwagon that everybody wants to be jumping on.
Great. One next question we have. In your presentation, you talked about executive pay and pay ratio disclosures. And you mentioned, not to focus on the level of pay, but the structure of pay. And you in the book, you go through a lot of evidence on that. But since this is about the role of investors, a big thing about investors is sort of the say on pay and sort of their role there on shareholder proposals, and also sort of their voice being expressed on that. Can you talk to us about the evidence on that, on how investors, because I understand media and others may, or the general population may be more focused on pay ratios. What about investors? What is the evidence that the role they can play there?
Yeah, so I think investors could potentially play a very positive role in terms of launching these proposals for long-term pay. So this was the Flammer and Bansal study that I mentioned earlier. But also there are investors who do focus incorrectly on things such as the pay ratio. So there is a recent paper by Stefan Siegel, Tracy Wang and others, which looks at the reaction of investors to the pay ratio disclosure, that the stock price typically goes down. And in particular, if the company has pro-social investors, it goes down even more, potentially because those responsible investors are looking too much at the division of the pie rather than the actual size of the pie. So what I'd like to encourage the investors to do when you engage in pay is to look at the evidence for what is linked to long-term shareholder value, and it's more the horizon and structure of pay than the level of pay. So if we are to engage, we want to engage on those dimensions. Now, that's not to say we can be completely blasé and completely ignore the level, right? Andrea asks in the questions, is there not a reputational risk there when ratios are too high out of whack? But I think here it's to try to justify and to be much more transparent on the reason for pay. In particular, if it's something where we can say, well, this is justified because the pay was 7-year equity, so that the CEO's only done well because she's performed over the past 7 years, then I think that might go some way towards addressing the issue. The other thing that I say to look at is, if we think about fairness and equality, a lot of the focus on the ratio is let's bring the numerator down, let's bring the CEO lower. But what about bringing the denominator up, right? So one thing that some researchers have looked at, in particular Paige Wimei and Ihan Kim, is giving broad-based employee shares to all employees. Because if a company like Disney does well, it's not just due to the CEO, it's due to lots of other people. And if indeed employees and the CEO have a slice in the pie, then everybody is benefiting from a growing pie. And so there's more alignment in that way.
Another part of your presentation, you talk a lot about the evidence on G and the connection between investor rights and and value and also some the studies showing that shareholder-friendly governance performed better, at least in the 1980s and 90s. But then you said, well, it's not universal and it may backfire, etc. As you said, most of that evidence was on G. Maybe turning over to broader on ESG. So kind of this conversation that's occurring now, companies coming out with statements like the Business Roundtable here, the CEOs of major US companies, prioritizing customers, employees, suppliers, communities over and beyond shareholder value. And you have also investors coming out, like the BlackRocks of the world writing letters to the companies. But in your book, you've focused kind of two types of investors: the hedge fund activists and this more generalists or index funds. So the question is, where are we in terms of this ESG conversation right now? And to what extent do you, what's the practical meaning of the statements of the companies? And what is the practical role that investors can play in a broader ESG conversation?
Yeah, thanks. So I think the practical meaning of the statements that were made is pretty much little, right? Because a statement in itself doesn't really mean anything. And actually, if you looked at the Business Roundtable statement carefully, and Luigi Zingales had an op-ed in the Washington Post around the time, everything that they're saying is fully consistent with Milton Friedman and shareholder value maximization, right? So they said, we're going to treat our workers well, we're going to treat our customers well. But that's just good business, right? Any business that maximizes shareholder value would want to treat its customers and workers well. So I didn't see that statement as being that different. So what really matters is, are they putting it into practice? And there's some views that they're not, including in the pandemic. I think the more interesting question is the second one that you asked is, what's the role that investors play? And again, we like to have binary thinking on this, which is, hedge funds are really bad, they're short-termists. Index funds are really bad because they're too passive. We want to have sort of active mutual funds. But again, the evidence isn't suggesting that. Different types of investors can all play their role. So there's evidence by Wei Zhang, Alon Brav, and their co-authors over a decade showing that activist hedge funds create value. And this is not just shareholder value, this is also through greater innovation and greater productivity. On the index fund point, there's papers by Apple, Gormley and Keim showing that index funds improve types of governance as well. And actually they have a subsequent paper showing that index funds and hedge funds catalyze each other. But what is interesting is that they engage in different types of activism. So I'd say there's two main types. So one of them is what I call generalized engagement. So this is sort of the more one-size-fits-all type thing, like lengthen pay structures, which typically is good in most cases, or put in clawbacks. And so that's something where if you're an investor which is spread really thinly, like a Vanguard or like a BlackRock, it doesn't matter, you can't get into the weeds of any one individual company. You can use your voting power to make those changes, and that's what Todd Gormley and Ian Appel and Todd Keim look at. But the other type is specialized engagement, where you want to get right into the weed, understand its business model. Let's think about Value Act. I know that you had Jeff Ubben recently at the Mayo Center.
Friday. Yeah,
exactly. So I'm standing on the shoulders of giants here. So we've got him, and he's like trying to change Adobe. You need to understand the business model, and that's something for the hedge fund to play. And what this means is then for policymakers, what we've got these stewardship codes out there, is that engagement is not a one-size-fits-all thing. So there's people saying, if you're not voting responsibly and voting on every single thing, then you're not a good investor. But actually, there's certain investors who will engage not through voting, but through other means, such as the activism of Value Act. And so what we'd like is that investors to engage in the engagement channel, which they have the comparative advantage in doing, rather than saying every investor needs to do everything.
Great. Your research on best companies to work for and all that suggests that there is value to CSR and all those efforts. And that is consistent a little bit with this mantra of do well by doing good. But academics research on investor funds that pursue SRI or are fairly mixed. It does vary on time horizon, on market that study, the methods that are used. And you also highlighted previously the direction of causality could go the other way. After you do well, then you can afford to do good. So how do you square the evidence? And particularly this sort of, there's two angles here. Again, the CSR or the company corporate finance type studies we may perform versus the actually earned returns by the funds that are focused. And how do you is it still an open question that investors can reap an alpha or some sort of excess returns from this? Or how do you come out on this gap between these two?
Yeah, thanks, Pedro. I think this is an important question because people like to ask, does ESG work or does it not work? And I think that's a stupid question, sorry, because, sorry to be so blunt, but it's just asking, is food good for you or is food bad for you? Well, some food is good for you and some food is bad for you. And to say, well, does ESG work? Well, it depends on how you're practicing ESG, right? So there could be some funds which are doing the very blunt screening, maybe screening on the basis of the incorrect measures. And there are others which might be doing the integration and understanding strategic context. And so that, I think, is the big differentiation between looking at ESG dimensions, like employee satisfaction or like governance or like pay ratios, and then ESG funds, because the difference between a fund and the dimensions is that the funds could be using correct dimensions or they could be using incorrect dimensions. So I think the important thing to understand as academics is what are the particular dimensions of ESG that works, rather than whether ESG funds work, because let's say ESG becomes the only type of investing scheme, well, then the average fund can't outperform because the average fund must market perform. So it's the strategies that matter much more. And I think that's a much more useful practical guidance. But again, we don't like that nuanced thinking. And so people have said, oh, look, SRI funds have outperformed in the pandemic, even though they don't do things like the controls for industry that we would like to do as academics.
Yeah, one question from the audience about capturing ESG through a single metric or even a set of metrics. One concern you raise in the book and elsewhere is, this sort of box-ticking approach and some data quality issues we have with ESG ratings, even some greenwashing that can occur when companies, influence those. So what are the practicalities? How can investors choose the right ESG metric and know what should be for each situation? How can so you had the SASB materiality map, but is that the working map you have in mind, or how can investors really, know what to look at and that it is properly measured on that particular ESG? I mentioned that will matter for that.
Yeah, great. So this was a paper. I learned a lot on this topic by a new paper which came out after I finished the book. So let me see. I'm just going to put I wrote a blog post about it, which I'm just sharing on the chat. It's by Florian Berg, Christoph Korbel, and Roberto Rigabon at MIT. And it looks at the correlation between ESG ratings. So we know the correlation between credit ratings of S&P and Moody's is about 0.95. So everybody knows what a creditworthy company is, but with responsibility, I think it's about 0.5. So this is much, much lower. So one interpretation is that this is all a load of rubbish, right? We shouldn't pay any attention to ESG ratings. Nobody can agree. But actually, the more constructive interpretation is that it's really difficult to define ESG. So what are the most material important issues? Well, let's say we care about measuring female friendliness. Do we measure this with the pay rate, the gender pay gap? Do we measure this with the percentage of women in senior management? Do we measure this by the percentage of women throughout the organization? And because different people will measure this in different ways, right, we are not going to agree. And also what counts as a good or ethical behavior. Some people might say lobbying is really bad, so we're going to mark you down. And others will say, well, lobbying is actually fine if you're using evidence to feed into government regulation. So I think what really matters is not so much taking the headline ESG rating as trying to go beneath it and to see, well, why is the ESG rating high or low? Going back to my food analogy, right? You don't care about the total calories of food, but you care about the protein and the carbohydrates and the fat, and it's often the underlying dimensions that matter. And again, I think this inconsistency is great for investors, not bad, because if there was one single universal rating, then that would immediately priced in. And that's one question that David Cicero was asking, right? If there were perfect measures, that would go away because, as we know from Jeff Pontliffe and David McLean, that gets put into the price. However, because there is not this agreement, what it requires is investors to break it down and understand what is this measure actually capturing.
Great. So we're running low on time. There will be questions on COVID, questions on regulation, maybe more, since there's so many of us in this room, lots of academics and students and some practitioners. What do you feel are the open research questions. What would you tell next generation of researchers to go out and attempt to answer?
Thanks. So I think, well, when we go back to one of your important questions, I think it's the important ones to answer your own questions. Your own question was, how do we as CEOs decide how to make decisions if we're not going to look at net present value? And one thing I said was materiality, which is how important a stakeholder is to you, which has been addressed by the study I mentioned earlier. But one of the other things I mentioned in the book is comparative advantage. So are you serving society in a way that you have a unique expertise in doing? And so one example of a case where you don't have comparative advantage is giving to charity, right? Why should a company give to charity? Shareholders can do it themselves. But an example of where you do have comparative advantage, you might say, let's take Mercedes. They're a great precision engineering manufacturer, and they're using their skills to make ventilators right now in the pandemic. But I don't know many studies showing the importance of comparative advantage. It's something that sort of intuitively should matter. And there are studies looking at the downsides of charitable donations. So there's a paper by Jun Yang and co-authors in the RFS forthcoming, one by Ron Masulis and Syed Reza. However, there's nothing looking at beyond charitable donations. Are the societal activities that you're engaged in linked to your comparative advantage? And is that something which is important for long-term returns? So I indeed want to look at those angles, because that adds further nuance to what should a company be doing, and importantly, what should it not be doing in terms of its investments.
Great. So with that, we're unfortunately out of time for today. Thank you so much, Alex, for your time, your insights today. Lots of listeners. Thank you all for participating, for your great questions. I will now turn it back to Rodney for the final remarks.
Well, thank you, Pedro and Alex, so much for sharing your research, your ideas, and most importantly, your time with us today. We very much appreciate all of those things. So on behalf of the Mayo Center and the Darden School of Business, we extend our sincere appreciation to all of you for taking time out of your busy lives to join us for today's session. It's through this series that we seek to bring you the very best ideas at the intersection of academic research, investment practice, and education. And so we hope that you found today's session very helpful to your daily lives. The presentations, as a reminder, for this and all of our virtual seminar series can be found on the events tab at the Mayo Center for Asset Management website. So we ask that you go there for more. In the coming days, we'll post Alex's session there as well, and that we ask that you be on the lookout for future Zoom events from the Mayo Center in the coming months. I want to extend a heartfelt thank you to the Darden team, ASME and IT, the Mayo Center team, Aaron and Stephanie, and of course our faculty, Pedro, and of course Alex, for taking their time out today. And then finally, a big thank you to our co-organizers for this event, the Financial Management Association International, for your ongoing and tremendous partnership in this series. We're very grateful. So thanks again, everyone. We hope that you all stay safe and well, and that we'll see you all again soon. Have a nice weekend, and goodbye for now.